The theme is really a series of three words. It's recession, recovery, and resilience. We've been through the recession already. It was jarring, it was sharp, it was very deep. There will be scars left and healing that needs to be done in the coming years, but that recovery is now in place. It's now intact, and we think it's going to get off to a fast start in the third and fourth quarters of this year before settling into a steadier but still positive pace through the balance of 2021. And as a result, we think that investors need to show here some resilience. There might have been some temptation to panic and to start selling during the recession and during the market sell off of February and into March. But now that the market has hit a bottom, we think there will be some additional volatility, some turbulence, let's call it, but that prices are generally on an upward track through the end of this year and into the end of 2021. And so we want people to remain resilient, not just through the recession, but through this coming period of turbulence that we expect as markets try to readjust their very, very optimistic expectations to the actual pace and timing of the recovery, which we think will be a little bit slower and a little bit more gradual than is currently priced in. So come the autumn, we think there will be some volatility. Hang tight, be resilient. We think returns will still be positive from that point through the end of the year and then through 2021. The forecast targets for the rest of 2020 foresee an economy that begins to recover with a strong push out of the gate in the third and fourth quarters before settling down to a more gradual pace in 2021. So our 2020 target for the US GDP growth is minus 4.5%. Yes, that's a contraction. For the whole year, it represents the sharp and very deep contraction and recession that we found ourselves in from February through probably May. But the overall picture, the message we want investors to take away is that the recovery in the third and fourth quarters will last through the end of next year. So a negative number for GDP growth, but a stronger number for equities. We think equities will be between 3150 and 3350 on the S&P 500 by the end of this year. Again, that progress from here owing to the fact that we're going to see a recovery in the second half. Likewise, in interest rates being a strong support for this recovery will remain low and low for a long period. We think the federal funds rate will be between 0 and 0.25%. So no more than a quarter percent, but probably closer to 0 for the next 2 years from the Federal Reserve. Likewise, Treasury yields will also be lower. We think the 10-year will be between 0.75% and 1.25%. So 0.75 to 1.25. And we think oil has probably made most of its recovery for this year and will be between $35 and $45 a barrel by the end of this year. A recession is a period of economic contraction, broad economic contraction. Some people think of it as 2 consecutive quarters, but this one was so fast and so deep that it's actually probably only going to be about 3 months. Officially, that recession began in February as dictated by the National Bureau of Economic Research and their recession dating committee. So beginning in February, we had a contraction. We think it's probably going to eventually be ended or called as an end in May. And so that's the recession that we think we've had this time. We're probably already in recovery as we speak, as this outlook is published. Well, we believe the economy would probably return to growth in June. And the reopening, although it's progressing at different stages in different states, appears to be progressing faster than we had thought. We're getting a strong burst of activity right out of the gate. We think that burst of activity will probably last into the end of the year before settling into a more gradual and steady pace through 2021. But this recovery is certainly encouraging to see, and we think it will make a big difference for momentum in markets finishing this year and then heading into 2021 on a positive note. Inflation has been a fear of many investors. We've seen this question come in because of all of the ammunition, all of the easing policies of the Fed. we think of the Fed as having this big bazooka, and the ammunition is liquidity that it pumps into the economy. The Fed has a lot of ammunition ready at hand, and certainly low interest rates do make for a lot of extra money in the economy. But what we have to remember is that unlike the 70s, or unlike the 60s even, there's not going to be a direct correlation between the amount of money in the economy and the amount of inflation. And the reason is that demand is much, much weaker today than it was in the 60s and 70s for a variety of reasons. One of those is that the economy just isn't as productive as it used to be, so wages aren't growing as fast. Another reason is demographics. The largest portion of the population, the baby boomers, are reaching retirement or already in retirement, and people who are retired just don't buy as many things. So the demand for goods and the demand for money is low right now, even though we have a lot of supply. That keeps interest rates low. It's going to keep inflation low, we believe, also. The sectors that are most affected are those that are directly in the front line of the lockdown. When we went to lockdown, those leisure sectors, leisure activities were all postponed. So hotels and restaurants, travel companies, airlines, all of the industries and sub-industries relating to travel and leisure, and any sort of activity where people would mingle. So think of sporting activities as well. Those are the sectors that were immediately hit and most, let's say, hardest hit. The sectors that were least hardest hit were the ones that people turned to as they were in the middle of the lockdown. So, what did people do? They watched a lot of television, they downloaded a lot of movies, they bought a lot of things via e commerce, even groceries. They went to hardware stores to get things to fix up their homes. Anything that involved activities around the house, those sectors and those industries tended to do well in terms of earnings. But we think overall for the S&P 500, the total earnings will end the year at around $115 a share. That's down from roughly $160 a share at the end of last year. So you can see the recession did leave a mark, but that mark was much deeper, much more of a bruise in those sectors that were directly related to the lockdown and the social distancing. So we think oil prices through the balance of this year will probably steady between $35 and $45 a barrel for the West Texas Intermediate crude oil. That's the typical benchmark for crude oil in the U.S. The reason for that is that although oil had some very turbulent weeks in the month of April, what has resulted from that turbulence is a lot of decrease in supply, not just here in the U.S., but around the world. The Russians, the Saudis, all of OPEC have agreed to production cuts. And here at home, we're seeing independent U.S. private producers lay down rigs, send workers home. They're not borrowing money anymore for new projects. They're not drilling. And what that curtailment in supply means is that eventually supply and demand will finally balance. We're already starting to move in that direction. That's why we're seeing oil prices move up a little bit here. And by the let's say third quarter, we'll probably see some stability and some steadiness in oil prices right around the low 40s. Yeah, that's a really interesting question. We think the pandemic, even if the rate of infection remains steady, that we think that will have a profound impact on how consumers approach their day-to-day activities and how businesses approach their day-to-day activities. We think consumers will be much more hesitant to take on debt. They'll be much more interested in accumulating savings. They'll also be much more interested in finding deals and bargains online. It won't eliminate brick and mortar stores, but it will accelerate, the pandemic will accelerate the trends towards more and more e commerce and more streaming entertainment as opposed to live entertainment. For businesses, the pandemic has been a very difficult adjustment insofar as a lot of businesses weren't prepared to be as flexible as they needed to be to maintain their operations during the pandemic. And so businesses will be working to develop parallel systems, let's say, so that if they're forced into a lockdown or if there's a new pandemic, the businesses will be able to get inventories and supplies from alternative suppliers. They'll be able to send workers home and still have production and activity take place. Businesses will be looking to get more flexible, we think, even as they try to cut costs and stay efficient. Some of the other trends have to do with the government. We think that because of the pandemic, the government will try to be much more proactive in terms of what it does and how it manages the healthcare system, and in particular, how this healthcare system interacts with other government agencies. You could consider, for example, that if there's an epidemic that starts in another country, the government may want to limit immigration in order to limit the health exposure to a new virus or a new bacterium here in this country. So we do expect to see more government involvement in the healthcare system, regulating the healthcare system, providing additional money for research and development, and tying information from the healthcare system to other areas of the government. That's going to be an important theme going forward. And we think the government will also take additional steps to maintain, let's say, more of an equity in incomes. Income distribution has been more skewed in recent years, and that skew has become much more accentuated during the pandemic. We think government policies will take on more of an active role, more of a spending role, more deficits, in other words, in order to create opportunities and jobs for people so that pay can go to people, income can continue to flow, and perhaps some of the wage disparity will be closed. So we expect the government, for better or for worse, to take a more active role in the economy, not just broadly, but in particular in the healthcare industry. It's still interesting to watch the countries of East Asia, in particular Singapore, Hong Kong, China, and South Korea. These are countries that have experienced wider problems with SARS, MERS, and other coronavirus type diseases, type viruses, over the last 20 years. They had much more of a national impact in their countries than we did in this country. And so you could say they're about 15 to 20 years ahead of the US in terms of developing systems and coordination, let's say, between the government, between the immigration officials, between the state officials, local officials, healthcare officials on how to manage an epidemic. And so watching them gives us a notion of how we might see the US develop in the future. We're already seeing quite a bit of return to activity in East Asia. I saw a picture of a park in Korea that I visited many times when I visited Seoul, and that park was full of people, and they were not wearing masks. That signals to me that this is a place that has already made significant adjustments in how they are approaching the pandemic. The U.S. could get to that point at some time in the future. We're not quite there yet. So that's something to look forward to. What it does mean for the immediate present is that Asia is probably ahead of us in terms of pandemic adjustment, but Europe is probably behind us in terms of pandemic adjustment. They are even less experienced than the US is when it comes to controlling a virus, and their means for supporting their economy have been less and much later than the US. That's one of the reasons why we like US markets better than developed international markets at this point in time.